Tuesday morning brought the first preliminary GDP estimate for Q2 2026. Alongside core PCE inflation, personal income data, and initial jobless claims, all dropping simultaneously. This is the most data-rich single morning of the financial year, and the results shape not just the Fed's rate decision this week, but the economic narrative for the rest of 2026. What GDP actually measures, gross domestic product, is the total monetary value of all goods and services produced in a country in a specific period. It is the broadest single measure of economic health available. When GDP grows, the economy is expanding. When it contracts for 2 consecutive quarters, it meets the technical definition of recession. The apparent contradiction in the current data: we have had weak jobs data. 57,000 new jobs in June against 117,000 expected. We have had strong corporate earnings. 38% growth in Q2. How can companies be growing earnings so strongly if the jobs market is weakening? The answer reveals something important about the current economy. Corporate earnings growth is being driven significantly by productivity improvements, specifically AI-driven efficiency gains rather than pure revenue expansion. Companies are generating more profit per employee and per dollar of revenue by using AI tools. This is good for corporate earnings, but it explains why job creation is slowing even as profits rise. AI is making companies more efficient, which means they need fewer people to generate the same or higher output. The inflation data that matters most, the core PCE deflator, the Federal Reserve's preferred inflation measure, dropping. If it shows inflation falling meaningfully toward 2%, the Fed has the justification to cut rates Wednesday. If it shows inflation staying elevated, the hold camp wins, and September becomes the earliest realistic date for any cut. The personal income story. Personal income data reveals whether wages are keeping pace with inflation. If incomes are rising faster than prices, consumers maintain purchasing power and the economic outlook is relatively benign. If incomes are rising slower than prices, the cost of living squeeze is intensifying and consumer spending will eventually slow. This feeds directly into the corporate earnings outlook for Q3 and Q4.